Hello, everyone, and welcome to MMP Fall 2020 Agricultural Industry Webinar. What a weird past 8 months we've experienced. We hope that you and your families and colleagues are well and are staying safe, and that an answer to this pandemic is quickly found. My name is Victor Kruger, and I will again host today's session. I am a Senior Vice President of MMP Ltd., the insolvency and restructuring arm of MMP LLP. MMP LLP is Canada's 5th largest professional services firm, with offices from Newfoundland to Vancouver Island. MMP believes in having specialized client service groups that we call niches, each with dedicated employees working in them. This specialization provides our clients and the industry with knowledgeable practitioners. We have identified 16 specific business niches, with agriculture as our largest and oldest niche, dating back to 1958 when the firm was established. As the agricultural niche is so large, it is further broken down into sub-niches, including food and beverage, intensive livestock, primary producers, Hutterites, and farm income programs. MMP is also the only professional services firm with a farm management consulting group comprised of professional agrologists and consultants who come from extensive agricultural farming backgrounds and bring a high level of technical expertise, first-hand knowledge, and close relationships with the agricultural industry to give us a real understanding of the issues faced by today's agricultural industry. The FMC group supports all of our other service lines in any ag-related engagement, and in particular in every agriculture insolvency or restructuring, where they provide us with expert advice to a specific situation and, if necessary, to be hands-on in a formal engagement. Our presenter from the FMC group is again John Lepke from our Winnipeg office. John is a professional agrologist who has close to 20 years experience providing services to the agriculture industry, starting as an ag lender and then as a consultant to the industry. John grew up on a mixed grain and hog farm in southeastern Manitoba and still lends a hand on the farm as needed to stay in ag shape. Our webinar again has been pre-recorded to allow you to watch it on your time. At the end of the presentation, you will find contact information for both John and me for your questions. We will respond as quickly as we can with answers. John, we look forward to your presentation.
Thanks, Victor. I'll start off just with a brief agenda. We're going to start off with looking at some market fundamentals. Then we'll transition over to talking about some US dollar and US trade. We do lots of business on the ag side with the US, so it's always important to see what's going on over there. And then we'll briefly run through each of the ag commodities in Canada. All right, so we'll start off by talking just about some market fundamentals. Obviously, the big news is COVID, and that's impacted worldwide and definitely in agriculture. I think earlier in spring when we were looking at this, the consensus was that people had to eat, and so that agriculture was going to be okay. And I think to a large extent that rang true. However, there was lots of unforeseen events that happened and unfolded that I think lots of people in the ag industry didn't foresee. Probably the biggest one is that we saw some volatility and some disruption in supply chains. As we kind of went through the beginning stages of the pandemic, we were definitely testing supply chains and seeing where some of those weak spots were. Definitely demand was typically in the past, demand has changed slightly over time, and supply is typically the one that's quite variable. This past spring, we saw demand changing faster, and as the industry tried to keep up with that, we definitely saw some cracks that that appeared, and we'll probably talk about that a little bit further as we go through each of the industries to take a look at each one. And as a general comment, probably what we noticed was that to a large extent, some of these supply chains couldn't keep up with that fast-paced change that was required as people shifted from working in offices to at home and lots of other things. So when we're talking market fundamentals, we also got to talk about trade. Obviously, Canada is a big exporter of ag products, and so trade is very important to Canada. And some of the trends that we've been seeing, obviously, our countries are starting to become more protectionist than they have potentially in the past. Everyone is obviously trying to, protect their local market and at the same time trying to push their product into as many different countries in the world as they possibly can. And there's usually a balance that happens there. But definitely, with some of the big players like US and China, we're definitely seeing that shift a bit where countries are starting to become a little bit more protectionist from that standpoint. Obviously, in Canada, the other thing we have to talk about is supply management. When we're talking about market fundamentals, the whole idea is you're trying to match supply with demand and keep those two very tightly in line. And even in that scenario, we definitely saw the supply chain starting to break down. In dairy, for example, 1 week they were looking at increasing quota because milk was flying off the grocery store shelves. And then the next week they were cutting back quota for farmers as, people started just consuming dairy products differently. So very interesting to see how the supply chain has sort of reacted through this. And I think lots of companies and lots of people have learned lots of things as we've gone through that they're probably going to enact for a long time. So as I mentioned, we're looking at doing lots of trade with the US, and just a little side note on that, every country tends to subsidize their farmers. Some are a little more direct, some are a little more hidden, but to a large extent, every country is focused on providing food for the people in their country. And so it's interesting as we kind of go through this and looking at this slide in particular. 2019 we saw the US starting a trade war with China, and definitely ag was a big part of that. And as you can see, starting in 2019, that gray bar starts getting a lot bigger, and that represents just the US subsidizing their farmers and trying to subsidize them through or due to that trade impact. Obviously, the USDA is forecasting a bigger government payment coming in 2020, and a lot of that is again trade, but also due to COVID. So when Canadian farmers are competing with US farmers, something to be aware of, that how they subsidize their farmers directly impacts how able Canadian farmers are to compete with them on a world scale. And again, dealing with the US as our largest trading partner when it comes to agriculture, we always want to keep in mind what the FX rates are looking like, as those can directly impact prices for commodities that Canadians are receiving. So, during the year, we've kind of seen us going from a relatively strong Canadian dollar to a bit of a weaker one, and then back to a stronger position just from an exporter standpoint. So again, just something to keep in mind, even though commodity prices might be changing for several commodities, important to also look at the FX because lots of commodities in the ag space are based off of US prices. So again, just something to keep in mind as we kind of talk about general ag commodities in Canada. So moving on to some issues or events that are happening on the trade scale around the world. First, we're going to talk about, the U.S. and the WTO, the World Trade Organization. They're definitely not an advocate of the WTO. The U.S. definitely is a large trading partner and likes to throw its weight around on the world scale. And the WTO kind of gives smaller countries a bit of a voice. So definitely something that they aren't always in favor of. And obviously would like to see major reform to the WTO, or Trump is talking about withdrawal of the U.S. from the WTO. So part of what they've done in order to spur that reform is they've been blocking, appointment of judges to the appellate body. And so that's the body that hears all the appeals to the WTO ruling. So with that judge or judges missing, that body can't function. No appeals are currently being heard. So all these trade disputes are kind of at a standstill. So the U.S. is kind of, in effect, brought the WTO down to being very ineffective and that they can't really function the way that they normally would. And we'll see some of the ramifications of that in a few slides. So moving on, talking about U.S. and China, they reached a phase 1 deal in January where China agreed to purchase 36.5 roughly billion of U.S. ag products in the first year. So far, to the end of August, they've purchased about 11 billion. Interestingly enough, China won its WTO case on U.S. tariffs placed on 200 billion worth of goods. The WTO ruled that those tariffs were inconsistent with normal trade rules. The U.S. would like to appeal the WTO ruling, but by its own accord, they've blocked the opportunity by not allowing those judges to be appointed. So interesting little twist there on how that one worked out. Moving on to Canada and China, relationships haven't been great. I guess chilly would be maybe a better term to use. Obviously, following the arrest of the Huawei CFO, China retaliated by arresting 2 Canadian citizens on espionage charges. And then, the canola export license, Richardson Viterra, were then suspended by China, and, they remain suspended till today. Free trade talks between Canada and China had kind of been rocky grounds, but everyone was hopeful that they were going to get restarted. But now, according to our foreign affairs minister, they're looking at it as saying, it's really not worth pursuing any trade talks with China at this point. And moving on to Canada and the U.S., the CUSMA or USMCA, whichever term you prefer, appears to be working out as a general rule from the Canadian farmer perspective. So obviously certain industries are being impacted more than others, but for the most part, it was good for Canadian ag. The one sector that did get hit was the dairy side. And what we've seen is a little bit of the devils are in the details on some of these trade deals. So Canada had opened up its dairy market to the U.S. And when we actually see it come into effect, what we've noticed is that the U.S. expectation was that they were going to be able to import finished product into Canada, milks and cheeses and yogurts and all that sort of thing. What actually happened was that they were only allowed to import raw milk components into Canada. And so they had to sell those to Canadian processors, which then blended them with Canadian milk to continue to produce normal products that landed up on the shelves. So I know the U.S. isn't terribly happy about that, and I think they're looking at what they can do in regards to that. But definitely the way the deal was struck versus how it's actually been enacted might be two different things. Moving on to poultry. Obviously, it's had its ups and downs, as most commodities have through COVID. But I think, we're still looking at a fairly positive outlook for poultry. Chicken is still the number one meat in Canada. And, we've seen some shift in consumer demand due to COVID. An example would be chicken wings, something that consumers typically would have eaten at a restaurant. As you move more to eating at home, we're definitely seeing people aren't as interested in eating chicken wings at home. So, certain things like that we're seeing less of. But, prices and consumption, I think, as a general trend, are still continuing to improve. So the outlook is still fairly positive for the poultry industry. Moving on to maybe looking at some of the impacts of COVID a little more in particular. We've seen a few supply chain disruptions. Two examples there, one in Calgary at the Lilydale plant, another much more recently at the Exceldor plant in Manitoba. So far those plants have remained open, but definitely there's the potential there that if the government were to shut those plants down, that there definitely would be ripple effects through the industry. One other thing that we've seen, demand for smaller turkey size is going up as gathering sizes are being mandated to be smaller in certain parts of the country. That naturally has led to consumers looking for smaller turkey sizes for Thanksgiving and for Christmas. And just a note on chicken, initially we saw that it was definitely demand was lower, and we were seeing about 94% of quota that the industry was looking for chicken farmers to fill. As the summer's gone on, that's kind of rebounded slowly. The hope is that they're going to get back to about 100% of quota fill production by Christmas, and then likely taper off again as they seasonally would. Looking at dairy, as I mentioned earlier, we're seeing some demand or some shifting in consumer demand. One thing that we did see was just packaging in the industry and how that was impacted during COVID. As people shifted to working from home more, an example would be consuming cream in their coffee. The processors were set up to produce large bags or quantities of cream, say for your Tim Hortons. And then as people started working from home more, they had a real hard time shifting their their supply chain to produce smaller volume creamers that you would normally see in your grocery store. So interesting from that perspective, just on how those items and how those processors were trying to keep up with consumer demand. The demand for milk and milk products was still there, but just how people were consuming it was changing. And processors, as mentioned, were having challenges kind of keeping up with that demand. Quota prices through this all has been interesting, and we'll take a look at that maybe in our next slide, and then we'll talk a little bit on some trade. So as you can see, quota prices for the prairie provinces anyways have been steady to rising in certain cases from the beginning of the year. And so what that really speaks to, I think, is optimism from dairy farmers, that they're still very positive on their industry and positive in regards to growing their farms. And I guess the other thing that we did see, and one of the reasons why we might be noticing that quota prices were increasing, was some of the incentive days or cover-off days were pulled back during COVID. And so farmers that are already geared up and had cows in place in order to fill that extra demand for milk and So rather than reduce production, farmers were making the choice to buy the quota instead, so that they could capture some of the profit from already having those cows on the farm. Talking a little bit about some of the trade impacts, we, from previous trade deals, CETA, CP, TPP are the two that we're going to talk about right now. The federal government announced $1.75 billion compensation package going out to roughly 11,000 dairy farmers in Canada. And so that was for market access that was given up during those two trade deals. So far, about $345 million was given out in 2019. The rest is going to be distributed, I believe, over the next 7 years. We don't really know the details of timing or amounts on that. Typically, that's announced in government budgets, so we're just going to have to wait to see when those actually will come out. As of today, there's also no details on any compensation for the CUSMA or USMCA deal. Likely, the government has been fairly busy dealing with COVID, so I doubt it's been given very much attention to this point, but they have announced when they did sign the deal that there was going to be some sort of compensation for dairy farmers. We just don't know exactly what that looks like today. Looking at crops, we're going to look at some 2020 harvest, also take a brief glimpse at some crop yields, and then talk about farm equipment and some farmland values. So again, going to focus a little bit on the U.S. here just to start off with, just because the U.S. does represent obviously a big trading partner, and also they do tend to set the price for certain crops on a world scale. So depending on how the U.S. harvest looks for certain crops, that will change the market price that Canadian farmers are going to see. So to a large extent, harvest is nearing completion in the U.S. They're back to some really big crops. Flooding was limiting some crops in 2019. They had some pretty widespread flooding that happened. Corn, for example, we're going from about 13.7 billion bushels last year, and they're forecasting an extra billion bushels in 2020. So conditions are good for harvest down there, everything coming off at a pretty quick pace. So we're looking at a very good year for corn yields down in the U.S. Beans, very similar, impacted by some flooding last year. And so they had about 3.6 billion bushels. And this year they're bumping that up to about 4.3 billion bushels. Acreage for soybeans was roughly the same year over year. They just have a really good yield. So growing conditions were quite good for soybeans down in the U.S. Moving on to Canada. The majority of the grain producing areas had really good harvest weather. A big change from last year. Harvest was relatively uneventful. Last year was probably one of the worst harvest conditions on record. Lots of moisture. Things got dragged out for a long time. Really hard on equipment when you're trying to harvest in really wet, muddy conditions. So I think most farmers were happy to be done with the 2019 harvest and very happy to be putting a good 2020 harvest under their belt. Another positive is that grain movement has been really good, better than it's been in a long time. Might have something to do with the oil industry not being as active, so the rail companies have more resources to allocate to the grain side. More than 75% of rail cars ordered to grain elevators have been spotted. So that's really positive. That means that, when guys are asking for cars, they're showing up relatively timely. And then on the other end, wheat, oats, barley, canola, are all ahead of our 5-year average for exports on a year-to-date basis. And really what that means is, anybody that's needing cash flow should be able to move grain in a fairly short period of time and turn that crop into cash. Unlike other years where sometimes you're waiting December, January, February before you could actually move your crop. So good for anybody that's looking for cash flow. From a yield perspective, I think in general, it's been better than expected yields. Certain parts of the country were a bit dry this year, so I think everyone is a bit surprised that the yields are coming off as good as they are. As far as progress is going, this is as of October 6th. We've had some good harvest conditions since then for the most part. So numbers will be a bit advanced from this, but Alberta was about 90%, Saskatchewan 96%, and Manitoba about 88%. So harvest definitely seems to be progressing at a good pace. What that does is allows guys to get field work done and seed bed preparation for next year. So sets farmers up nicely for a 2021 crop. And also the other impact is it allows manure management to happen on a timelier basis. So anyone on the livestock side that's looking to spread out the manure has a good time window to do it this fall versus really rushing and mucking it in. So just looking at some estimates, Stats Can give some estimates for the 2020 crop. We're looking at a bit of a smaller soybean crop this year in Canada, about 20% decrease from what we saw, the peak being in 2017. Again, similar to the US, we had good yields, but guys are just planting less soybeans than they have in the past. Canola, again, is a bit smaller this year. About 19.4 million tons is the estimate, which is about a 10% decrease from the highs that we saw in 2017. And that's due to a decrease in the harvested area and also the yield. And largely, that was because when guys were making planting decisions, canola and soybeans didn't look like they were going to be that profitable. So guys chose to move acres out of those crops. And as you can see, lots of those acres went into wheat. So we're looking at about, the second largest acres in the last 5 years. So pretty big wheat crop coming in as guys saw profitability on the wheat side when they were making planting decisions earlier in the spring. So moving on to farm equipment, I always say that, farm equipment is a bit of a pulse of where farmers are at mentally. If they're feeling good about, their business and where they're at, likely they're going to be going out and buying, pieces of equipment, replacing on a bit of a faster scale. If they're a little bit more cautious, they're seeing signs in the industry that are telling them that, profitability might be down. You're going to see that slow down. So as we see here, two-wheel drive tractors are up a bit. Those will be lower priced units for the most part. Your more expensive units, your four-wheel drive tractors and your combines, both of those are down year over year. And definitely speaks to the fact that coming off of a really hard harvest in 2019, prices not being that great in the spring and going into early summer, most farmers were holding back on spending any extra money and taking a wait and see approach. As we'll see later on, I think we're probably going to see a reversal of that coming up, if I'm right. So moving on to farmland values, I just graphed out the numbers from FCC for Alberta, Saskatchewan, Manitoba. as you can see, they're all trending up on a 20-year average, and trending on an increasing basis as we go forward. Price of land usually is a little bit of a longer-term lag on where farmers are at and how optimistic they feel about their industry. Equipment is usually that leading indicator of how positive they're feeling. But as a general trend, we're seeing land values increasing, and I don't think we're going to see that change anytime soon. So the reason I say that is, we're seeing farmland values going up about 5% in 2019 on national scale, and we're expecting those to increase going forward. Your major drivers of land prices, it's crop income, yields times prices, and your interest rates. So when those two come together, then typically we see land prices going up at a fairly rapid pace. And in today's environment, we're seeing some really, really low interest rates, probably the lowest almost we've seen historically as far as interest rate goes. So borrowing to buy farmland is extremely cheap. And, you couple that with some good grain prices and some good harvest that we're coming off of here in 2020. I think it's a recipe for land values to increase again. Moving on to hogs. Out of all the commodity groups, I think hogs was probably hit the hardest due to COVID. They really had some real big price volatility. Lots of big kill plant closures down in the U.S. And interestingly, what happens when we see that is that they're just the price just falls out for hogs because there's no demand from the kill plants. Because there's just a glut of hogs all of a sudden that have nowhere to go. So one plant closes, and those hogs try and get diverted to other plants, but at some point they just can't take on any more hogs, and then the price goes down. So farmers were seeing some record low prices. In certain cases, you almost couldn't give away a hog. Like it was getting to that point. Conversely, on the other side, on the grocery store, we were seeing prices go up because kill plants were closing. And so there was less actual product available at the grocery store level. So a bit of a disconnect, but when you think of it, it all made sense as to why hog prices were so low for farmers and so high in the grocery stores. I guess the other trend that we're seeing, going into this fall is that feed prices are starting to rise. We've had some really good prices and a rally in the grain markets recently. So definitely, depending on what part of the country you're in, you're probably feeding corn or barley, but both of those have been going up. And so we're definitely going to see some pressure on feed prices as we're rolling through the fall here. I think we'll move on and talk a little bit about trade. We've talked, with China, talked briefly about it, but we'll focus a little bit more on Canada, and it ties in really with some disease pressure, African swine fever. China's gone through that, and there's definitely been some impacts to the Canadian industry from that. And just moving back a little bit to profitability, using Manitoba as an example, here's the gross margin that we've seen for a fair to finish hog operation, over the last couple of years, going from, $45 all the way up to, almost $67 on a gross margin basis. So definitely, I don't think we're going to see any records being set for 2020, just with prices being so decimated for an extended period there. That being said, we're rallying and we're seeing some fairly decent prices going forward. So I don't think it's going to be a train wreck of a year, but definitely won't be a good year either for most guys. And just a bit of an update on African swine fever. China is kind of had the biggest impact. It lost 60% of its breeding stock, and so it's rebuilding. And looking at it, their sow numbers grew 37% year over year as of August. So they're definitely rebuilding their sow herd. It obviously is just going to take a whole bunch of time. The interesting piece is that the sow herd that they're rebuilding isn't going to be as productive as the sow herd they had. They're not using high quality genetic stock for the most part to rebuild. They're just trying to rebuild as quickly as they can. So they're using some of those lower quality sows. So what that means is they're going to have the same number of breeding stock, but they're going to be producing less pigs for consumption at the end of the day. And so as we see that herd grow, demand for feed is also growing. So that's a little bit of the reason why you're seeing some of these grain prices rally. China is definitely buying more in order to feed this growing herd. So African swine fever has impacted China. It's also stretched out into Poland, and a lot more recently we're finding it in Germany now. So everyone's very, very cautious about this. And the reason being, as soon as it enters into your country, basically your export market is done. No one wants to get the disease in their market. So as soon as you test positive for it, basically you shut the border down, and no one wants to take your pigs. So that is why everyone is so very concerned about it and why it's receiving so much attention. Moving on to the cow-calf, I think we're seeing, I'd call it probably stability in Canada. Herds probably shrinking a little bit. We saw, 0.8% decline in heifers and a 1.4% decline in cows. So definitely we're seeing, the herd shrinking very slightly. And that has been a little bit of the trend recently. I don't think it'll continue to shrink in any great effect, but definitely seems to be the trend that we're seeing today. We had a bit of a slow start to the fall run with calves coming off. But that being said, we had pretty good forage and feed grain, so we're seeing some good calves coming to market at this time. And moving on to feedlots, definitely we saw some plant closures, although temporary, and that definitely had an impact as animals couldn't move out of feedlots and into the plants. As we've seen with other commodities, corn and barley, we're seeing those feed prices trending up, and that's going to impact margins for certain guys. Depending on what their risk management strategies are and how far out they might have priced certain commodities. We've seen some government programs come out due to the temporary plant closures. In specific, Alberta, Saskatchewan, Manitoba, and Ontario, they've all in recent months introduced a set-aside program between, the federal government and the provincial governments. I think 40 million was allocated for Alberta, 12.5 million for Saskatchewan, and about 2.5 million for Manitoba, roughly. So anybody that was kind of keeping their animals back in feedlot because they couldn't send them to the plants because they were closed, there's some money that can at least help them offset those extra costs. Moving on to wineries. I think the industry as a whole has weathered COVID not too bad, with wine consumption up in general. However, that success isn't totally evenly split or shared. Smaller wineries definitely have been impacted more. They've had, I'll call it, more market issues. They tend to sell more direct to restaurant sales, have tasting rooms, that sort of thing. That whole agritourism, if you want to call it that. So obviously with COVID impacts, those parts of their business have all been shut down, and that's impacted them and their profit margins. The really big wineries, on the other hand, were able to capitalize on importing some cheap foreign sourced wine and selling it. So, they've done actually quite well from that perspective. Vineyards, it's been a long, hot, dry summer and fairly early fall. So quality is excellent, but volume is a bit down in certain circumstances. And with a bit of the higher import situation from some big wineries, there tends to be a big amount of fruit, mainly whites, that may not get harvested at the end of the day. Ice wine sales are kind of off a bit with China and the whole trade war. So this kind of further compounds a bit of that white grape surplus. I think overall quality is probably pretty good this year. Sales are good, although a lot of it might be that import product and not Canadian. And then, there's impacts from some of the trade that's happening. Australia had a trade challenge related to some excise tax, which went against Canada. So not necessarily the best for the industry, but I don't think it was terribly unexpected either. On a wider scale, California obviously had some major issues with wildfires, and that impacted a significant portion of their crop that wasn't harvestable. But rest assured, I don't think the world's not going to run out of wine anytime soon. Certainly seems like there's a lot of inventory on a world scale. Moving on to cannabis, we're seeing retail sales increasing over the last few months. So that's good news for the industry. We're also seeing a bit of a change in the price point. Up until a few months ago, branding had really been around a premium product, and the industry seems to be moving to try and compete with, lack of a better term, probably street product. So I think that's a large part of what's driving that increase in sales. Certain companies are definitely sticking to their guns and saying they're still a premium brand. Other companies are lowering prices, and product obviously isn't the same quality, in the hopes that they can kind of grow their customer base into that premium product at some point. So generally, commoditization is still happening in the industry, and part of that is, obviously reflected in that changing price point. So, and we're continuing to see joint ventures with food and beverage. That definitely seems to be where growth is focused in the industry, and where companies are looking to get a competitive edge. And moving on to food and beverage, I think pre-COVID, and this probably still stands today, margins are continuing to get a bit squeezed, and companies are looking to reduce, energy, water, waste, any of those areas they can, just to try and reduce those costs. And now the added costs, PPE is definitely a big one. I think big companies, it sounds like, for the most part, have been early and have been able to access PPE. Some of the small and medium-sized companies have had a bit of a harder time getting it, and of course, it does add to their fixed costs at the end of the day. Added to that, the industry has always struggled with labor, and definitely that's coming out even more today. That there definitely seems to be a labor shortage for working in the food and beverage industry. So. That kind of ends my talk for today. and I will turn it back over to Victor.
Thank you, John, for another insightful presentation. We would like to thank everyone for participating in this webinar and would encourage you to contact John or any of our other FMC practitioners directly with any specific agricultural questions. Any insolvency related questions can be directed to me or any of our cross-Canada insolvency team. The appendix to today's presentation includes further information about MMP and our Farm Management Consulting Group. This webinar has been recorded and sent to all of you as you had requested to be added to our Ag Webinar distribution list. And it will also be posted to our mmpdebt.ca website. Please feel free to forward the link to your colleagues and encourage them to contact me directly should they wish to be added to the distribution list. We look forward to your participation at our Spring 2021 webinar and look forward to hearing from you with any questions or comments you may have. So stay safe and goodbye, and we'll talk to you in the spring.